Welcome to another weekly portfolio update here on The Last Investor. My name is Dan. I'm going to give a brief update on how my portfolio has performed over this past week. And then for this week, I will then talk about why there's still value to be gained from innovation because of the Wright'S law phenomenon. But first, a big thank you to all those who have subscribed to the channel, and if you're new and you like the content, then please show your appreciation by subscribing, and that would be much appreciated indeed. But first, let's delve into the portfolio update. As you can see, my portfolio is up £508.95, and my total value is now standing at £10,650.95. That's a 4.7% increase in my portfolio overall value. So on to the portfolio update. So of my top 7 main stocks, which are worth over £500, CRISPR in the last 7 days has gone up by 7.1%, and that's an increase from the previous week when it went up by 6.3%, so it's still growing. And when I think about CRISPR, and when I first invested in it back at the beginning of the year, it's gone up a staggering 84%, so that's quite incredible. And I'll be sharing some stats later on when I talk about my topic on innovation. The fact that it's still got quite a significant room to grow, it really is staggering to see how far this has come and how far it's still got to go. And then the next one is Rio Tinto. In the last 7 days, that's gone up by 3.8%. Last week it was up 1.4%. So again, there seems to be an upsurge in the market as far as the mining industry seems to be concerned. Now, now looking at it, it's up 20% overall, which is £168 gain for me on that stock so far. Aviva in the last 7 days is up 2.1%. Overall, it's still down roughly by 6%. Centamin, again, another fantastic stock which continues to see growth. In the last 7 days, it's just gone slightly down 0.39%, but overall it's still up 72%. Then we have 3i, which in the last 7 days is up 2.2%, but still down overall by 19%. Then we have Trig. Again, in the last 7 days, Trig is just down 0.61%, but overall it's just up slightly by 2%. And Carnival Corp, which is the final one, which is above £500 in terms of my overall holding, is still down overall 51%, and last week saw a slight increase of 1.5%. Now, in terms of new stocks, I haven't really purchased any new stocks this week. But what I've done is that I've continued to dollar cost average into my stocks that are currently in the negative and which are still under £100 in value. And the new stocks I've purchased are Atlassian. I think I added £10 worth on the 16th of July. And I did the same basically with Square. I did the same with BHP. As you can see, that's also in the negative at the moment. And I also did it with Bluefield, which is also in a negative. But also I added some more shares into PagerDuty as well, and also into Alphabet, and as well I added into Twilio. And the reason I did that is just to build my holding in these stocks to at least £500 over time. So whilst I'm being cautious not to put large sums in one go, I still want to invest on a weekly basis just to build up these holdings, as I believe in them long term. So that brings me on to the topic I want to talk about today. I think it's fair to say that people are really worried about where to put their money these days. For sure, I think on any valuation model that you choose, the market is arguably overvalued. But there is one metric which arguably is bubble proof, and that is Wright'S law. But before we dive into this, I'll play a clip from my favorite investor, Cathy Wood, and she explains the phenomenon of Wright's law and how this is significant in the world of investing.
I think one of the things that people almost underestimate the most is this impact of innovation. How do you use that to exploit some market inefficiencies and find some of these stocks that you look at?
Well, we are centering our research on something called Wright's law. Now, Wright's law is very specific to innovation, and it's actually a relative of Moore's law. Moore's law, however, is a function of time. Wright's law is a function of units. And it basically says for every cumulative doubling in units produced, costs decline at a consistent rate. So what we are looking for in terms of impact is figuring out, have costs associated with one of these platforms drop to a low enough level that they're going to unleash waves of demand and get us into that exponential growth curve. So whether it's DNA sequencing, we're there. To give you an example, DNA sequencing costs now are below $1,000. Last year, the number of whole human genomes sequenced around the world was 2.4 million. That was half of all the whole human genomes ever sequenced in history. So we're already at the tipping point, and we believe that number is going to go to 100. So that's almost a 40-fold increase in the next 5 years.
So this concept of Wright's law is a really important one and has really been demonstrated to be accurate in predicting how innovative technologies grow over time. So Theodore Wright first made this observation when he was analyzing the production of aircrafts in the 1930s. And what he discovered was that for every cumulative doubling in the number of units produced, there was a consistent cost decline in percentage terms. So during this period, he discovered that, for example, the cost of producing the 2000th plane was 15% cheaper than the production of the 1000th plane, and that the cost of the 4000th plane was 15% less than the 2000th plane, and so on. This phenomenon of reduced cost per unit as the production doubled over time has since been applied to various examples of disruptive innovations, and the results were exactly the same. This can be seen in the following examples. For example, Ford's Model T, when it first came out, fell over time consistently as the number of productions doubled. Then the solar electricity cost per megawatt hours also fell with each doubling of production over time, as can be seen on this chart. And then lithium-ion batteries also had the same results, as can also be seen on this chart. Then we have the Human Genome Project, which took 14 years and at least a cost of $2 billion to sequence the very first human genome, which was concluded in 2003. But today, the cost for sequencing any person's genome costs under £1,000 per person, and it's still falling. Significantly, however, is how quickly these disruptions occur. They occur on what is called the S-curve. You will often hear Cathy Wood do that upward hand movement, which she often refers to as an exponential growth. The science behind this is that adoption of disruptive technology goes from 0% adoption to 100% adoption in the shape of an S-curve. It has 3 stages. The first stage is very slow and is represented by the horizontal part of the curve. And in this stage, only early adopters and early believers take up this technology. Then it reaches a tipping point where the adoption or growth becomes exponential. And this is where we probably are in relation to much of the innovative technologies out there now. So this is likely just the beginning of the tipping point. Then the third stage is when we get to the top of the exponential growth curve, and it slows down once the technology is fully matured and adoption is complete. So, for example, ICE cars are at the top of the exponential curve and it's fully saturated. But EVs are arguably only just at the beginning of that tipping point, and there is a long way for growth. So with this in mind, it can arguably be said that investing at this stage is a prudent entry point for these innovative technologies, despite all of the concerns about the state of the economy today. Now, Cathy Wood in this same interview went into some more detail about this, and when she was asked about whether most of these stocks are already overvalued, mind you, this interview was done last year, but I think her answer is still relevant today because of Wright'S law, and I'll play a clip, then I'll break it down a bit further.
A lot of the companies that we talk about today that seem to be seen as innovators in the market, often a lot of the good news going forward is priced in. Do you think there's a point where the market turns on some of these companies and there almost becomes like a dot-com bubble if they're not delivering what they say they're going to do? You know, a lot of these companies that, for example, aren't profitable yet. Do you think that there's a point where the market has said, all right, we've had enough?
I love the question because I believe many people are fearful that after 10 years we're in some kind of bubble. I'm going to give you a really, I think, provocative way of explaining this. If I had told you or any investor in the late 90s that there were going to be 3 companies with the foundational patents behind CRISPR-Cas9, which is the most advanced gene editing flavor, I'll say, these days. And I had told you these companies are going to cure diseases that have been the scourge of human existence, right? They're going to be able to cure pediatric blindness or cancer, as I mentioned before. My guess in the late 90s, when investors were chasing dreams and too much capital chased too few opportunities too soon, that those 3 companies would have accumulated in market cap to roughly $200 to $300 billion in market cap, right? They would have, because they'd get a royalty on every therapeutic that was going to be developed. And today we think the recurring revenue base in terms of the therapies just for single gene caused diseases, we think that's a recurring revenue base of $75 billion. They'd get 10% of that. Single genes are responsible for only 2% of all diseases. That's just the beginning. So the idea of $200 to $300 billion, certainly in the bubble, easy. Today, those 3 stocks in the market together can't even reach $5 billion in market cap. Now think about it. Apple is a $1 trillion market cap company, and it's changed our lives, and we love our Apple phones and AirPods and watches. But Apple is not curing cancer. It's not curing disease. These companies, we believe, will. But there's so much fear in the marketplace, and there are all kinds of reasons to avoid them. The cap is too small, which is the kind of circular reasoning. The cap is too small, or they've just entered human trials. I'll wait to see what happens. Well, that'll be too late if these human trials are successful. One of the first one being pediatric blindness. A baby born blind, you correct that programming error. The baby can see. It works in mice. It works in non-human primates. If it works in human beings, think about what the reaction will be. Well, we prefer to be in the stocks before that reaction. And you know, one thing I'd like to emphasize, our analysts have domain expertise. Manisha Samy, one of our 2 genomics analysts, worked in Stanford University's biology research labs for 8 years. She experimented with CRISPR gene editing. She's now volunteering at Memorial Sloan Kettering with one of her Stanford professors, and she's still experimenting with different technologies like CRISPR and DNA sequencing, but more important, she's seeing the researchers' reactions to these new technologies, their excitement. So I really believe we have domain expertise here, and Manisha really believes this is going to work.
So as you can see from that video, Cathy used the analogy of the totally addressable market for the gene editing technology. She sees it as being around 200 billion at the very least, and at that time their total market cap was less than 5 billion. And today those same three leading companies have a combined market cap of 9.64 billion. Intelia having 1.3 billion today, Editas 2 billion, and CRISPR 6.34 billion. Whilst they've doubled in market cap since that time, Cathy's estimation of 200 billion market cap could still be realistic, which is approximately 20x growth if it happens. So based on that, arguably these stocks still have a long way to go in terms of growth, and they are still at the early stage of the S-curve and probably yet to hit that tipping point. In which case, taking that opportunity for growth into account, they could be considered as undervalued stocks today if they do live up to that expectation in the future. Finally, when there's exponential growth in one sector, then the incumbent technologies or companies in that sector often get disrupted, and there will be a decline in their dominance in that sector. So those companies are potential value traps, really. People might think they're cheap, but they are in truth heading down a one-way road to extinction. And Cathy Wood talked about this as well in that video. She talked about how Square and PayPal will disrupt banks through fintech, and EVs and battery technology will disrupt the crude oil industry. So the traditional auto industry and oil industry will be going in the opposite direction on that S-curve. People might not see it happening today, but as costs decrease through doubling of production, it will become even cheaper to produce EVs, and the reduction in costs will be accelerated by lower battery costs, which will translate into cheaper EVs. And once the cost of an EV is lower than a traditional ICE car, then that pretty much is game over. But of course, I must stress that this is not financial advice, and I'm not endorsing one particular asset over another. I'm just basically sharing my own philosophy on how and why I invest in what I invest in. And on a final note, earnings week for the big tech companies is upon us. So we have a number of big tech companies that will be releasing their earnings for this quarter. We've got Tesla, Microsoft, IBM, Snapchat, AT&T and Intel. They will all be reporting, and we also have some airline stocks which will also be reporting, so that's worth looking out for. I suspect we'll be seeing some market volatility based on the respective announcements. Perhaps some pullbacks may well be on the cards as well, with some of these tech stocks possibly taking a bit of a hit on their share price, but we'll have to wait and see. Anyways, I hope you've enjoyed today's video, and please leave a comment, like and subscribe. Peace.